This is the most asked question in the investment banking. Let's say you are analyzing a company for a valuation or M&A, and you might wonder, why do the investment bankers, private investors,
are some of the fields where there's a lot of scope for innovation and where you see still there's a lot of room for growth.
Fintech,
isn't
health tech
net income the bottom line, or well, EBITDA tells a cleaner story. That's today I'll explain why it will go for the metrics of financial analysis. Let's say EBITDA stands for the earning before interest, tax, depreciation and amortization. In simple terms, it's operating profit before the non-cash expenses and the financing decisions. Let's say EBITDA is equal to net income, interest, taxes, depreciation, amortizations. It strips away the effects of financing, let's say accounting choices, or you can say that the tax policies. That's showing the core profitability of the company's operation. Why not the net income? So its net income includes net interest, taxes, depreciation and amortization. And you can say that's the one-time gains or losses we can also deduct from them. That's why net income can vary a lot, because between the two companies, even if they operate the same business. Let me take an example. Let's say a capital heavy manufacturing will have the depreciation and the interest, while a tech startup may not. It's an asset light model, but both can have a healthy EBITDA margins. Net income punishes the company for the capital structures and the accounting decisions that does not reflect their actual operation performance, but the things. Let's say EBITDA operating cash flow, or we can say that the cash proxy. Let's say EBITDA is often used as a proxy for the operating cash flow that is not exactly the same. Investors want to know how much cash does this business generate from its core operations before the debt payments and tax bills, etc. And EBITDA help to answer that, because it normalizes for the different structures and let you compare the apples to apple. That's why when the bankers value a company using the EV by EBITDA multiple, they are essentially asking how much you are paying for each unit of the operating profit. This is especially useful in the M&As, leverage buyouts, private equity, where the focus is on the cash generating ability before the capital decisions. Let's say another big reason EBITDA is a capital structure neutral. Two companies with the same EBITDA but a different debt level have a different net incomes because of the interest expense. But for the valuation or the comparison, you want to ignore how a company finance. That's why EBITDA or EV is paired with the EBIT numbers or the EBITDA numbers. Both are pre-interest metrics. This is the neutrality in the critical M&A or IPOs, where the analysts compare the business models or financing decisions. Let's say limitations of the EBITDA is also there. But remember, EBITDA is not a perfect. It ignores the working capital needs. It ignores the capital expenditures, which are real cash flow that can be manipulated by excluding the adjusted items. But it should be the another matrix that is working here. So free cash flow or the EBIT. For the full picture, we can say that. So let me summarize this in a big chunk. So EBITDA gives a clear view of the operating performance. It ignores the accounting and financing noise. It helps to compare the companies across the industries and region. That's why investment bankers prefer EBITDA or the net income, especially for the valuation, M&A and the investment decisions. That's a one thing everyone is making right now. So if you want to raise a funding for a startup, or looking for the financial modelers, the investment banker or ibankers.com can be a place for you. You can visit there and find out the financial model templates, and apart from that, a lot of the resources and free of cost for you to grow a business and make the investors ready for a business. Let's meet in the next video. Subscribe the channel and like the videos for the more content.